as my subscribers know, I've been kind of going back and forth on the whole, is inflation transitory, not transitory? I've leaned so far, and I'm still sort of leaning to the transitory side of the fence, but only just. And the reason why I sort of gone back to the middle in the last little while is, as new metrics have come out, we're seeing more, what I would refer to as sticky prices, and that would be things like wage increases, rents, things that generally you don't see drop down again and lose their gains, essentially, unless there's a recession. That's almost always what it takes to actually stop inflation in those sticky items like that. And we have seen those. They're not going crazy. They're definitely not the main part. They still are not the main part of the higher inflation rate, but they're definitely getting bigger. So I think it's clear there's definitely going to be some residual inflation, even if the transitory stuff comes off. So it's not like it's going to go back to 1% or anything. I don't see that happening anytime soon. I've spent a lot of time lately trying to figure out what the hell's going on with supply chains. I find it quite odd that, I don't find the supply chain issues erupting to be surprising. What surprises me is that it's taking so long for them to get worked through, and people that are specialists in supply chains that are in the supply chain industry, if you will, most of them are quite skeptical about how fast this is going to get fixed. I mean, they're mainly talking middle of next year, and that's the other reason why, transitory, mandatory, depends on how you want to define it, because it sounds like some of the issues and supply chain issues are a big part of this. Those aren't going away anytime soon. I find it a little bit shocking, honestly. It does bring into question the whole just-in-time inventory everyone's been using for 30 years. I really didn't think it was going to take a year and a half to fix this stuff. We're talking about shipping at the end of the day for most of this. But, I would note that if you look at the bond markets, if you look at how bonds in general are trading, you look at the yields, most of them are at least in the middle of the transitory, not transitory continuum like I am. And in fact, most bond traders seem to be highly skeptical that the inflation rate is going to stay up. You can see that simply and easily based on where bonds are trading and what the yields are. If a bond trader thought we were going to have 6% inflation the next year, he would not be buying treasury notes up to the point where the yield was 1.3. So they clearly do not believe in the inflation scenario. We're gonna find out what's gonna happen. The conundrum and the confusion and the annoying thing in the last few months has been this kind of backdrop. You really should be expecting and getting a better performance out of the gold market, out of all the precious metals. This is, by definition, certainly by my definition, the classic bullish scenario for precious metals. And that's long-term negative real interest rates. It's not clear to me yet, honestly, why this isn't happening. Maybe it's fear of the taper that it's going to come in some point in the next few months, I think. And the other thing that's unfortunately not helping the resource space, not commodities in general, but the resource space, when you think of stocks, is again, we've got a really crap year for asset turnaround. There were several other companies that were humming and hawing and wanted to present at this myth. And the reason why a lot of them didn't, quite frankly, is they got no results to talk about. They're not sitting on stuff. Believe me, I know a lot of these guys. I talk to them. They're swearing down the phone, talking about how terrible the lab turnaround is again this year. We thought it would be fixed. It isn't. That's another thing that's not helping these stocks. But that problem at least should take care of itself once the northern results start flowing in, and we get some nice ones from Brandon, the next presenter this morning. Once they start, we should start seeing a lot more regular news going forward. But it's taken a month longer than you were expected to. So that late August lift that you often get in the sector just didn't happen. Now, when I look at the whole transitory, non-transitory argument, here's a really long-term chart for you. Unfortunately, this one starts just after the original, if you will, the original gold bull market in the 70s, but it gets the point across. The blue line is CPI, US CPI. The white line is 10-year bond yields. Essentially, if the blue line is below the white line, then real interest rates are positive. If it's the other way around, they're negative. And as you can see, for virtually all of that period, really until about 2013, 2014, we had positive real interest rates. The scale of the positivity shifted. And if you take a look in the middle of this, if you look in the middle of the chart, you can see there's a couple of spots here where you see these kind of jaws narrowing, and those were previous periods where gold did well. It doesn't seem that it has to be negative real rates so much as declining real rates. Of course, the real anomaly is the one that we're right in the middle of right now. That's a pretty amazing tail on that chart. You can see bond yields have gone up, but really not very much at all. Bond traders are clearly not buying in to this much larger jump in inflation that we've seen. If they thought that was normal and lasting, you'd see nominal rates up here someplace, and that's not happening. It doesn't look like it's going to. But again, this type of action, if we see the rates continue to stay low or we see inflation continue to be elevated, it's generally the positive background for commodities in general. Now, like I said, I'm not completely out of the transitory camp. You take a look at this. This is the August CPI and the core CPI. The core CPI was actually more of a surprise, interestingly. Sorry about that. It was more of a surprise than the full CPI, but you can see both of them drop quite a bit. The fall from July and especially June to August, and the fall from sort of April to June down to August in the core. It's quite substantial. You can see that things are definitely decelerating. And interestingly, you can see that if you take a look at this shows you, this is a core index, but they've broken out parts of it. So the yellow is changes in used car prices, red's airfare, hotels, travel stuff, basically. And blue is the core rate with those excluded. And, it's pretty obvious here. After we came out of the first wave, and definitely after the vaccines came in, when things opened up, that's where you really saw the inflation push. But a lot of that push was in things like travel, people getting out there. Another thing, oddly, was used cars. And I think there's two reasons for that. One is there's been a problem with car manufacturing because of semiconductor availability. That's a whole other supply chain thing. But it's also the fact that I think, frankly, after a year of COVID, a lot of people who maybe are just on the edge of affordability when it comes to being able to drive to work said to themselves, I don't want to be in a bus or a subway car with 50 other people. Screw it. I'm buying a junker. So that's the reason why used car sales did so well. But you can see that those came off. They were actually, in August, they actually both took away from the final rate. But you can see also, though, if you drew lines here, you'd see the core rate has gone up. So I'm not saying I think inflation's gone back to 0 or 1%. It looks to me like it comes back to, say, 3 or something, which is not insignificant in terms of what we're thinking in terms of positive, negative real rates. Interestingly, again, I thought this chart was interesting because this one is professional investors, and the definition of professional investors is essentially fund managers, hedge fund managers, and it's how many are expecting higher inflation going forward. And as you can see, as you came out of the pandemic and then sort of to the end of Q1 this year, that went through the roof. I mean, basically in March, April, 80 or 90% of the fund managers were expecting higher inflation. That's back to zero, which and zero in this case basically means 50-50. Half of them do, half of them don't. I suspect we'll see that fall further. I think this helps explain what's going on in the bond market because these big institutional investors, of course, them and sovereigns are essentially the treasury market. Treasuries are not a retail market. So I think this helps explain why you're just not seeing the bond yields move the way everybody thought they might. And again, here is the chart itself. Here's the 10-year yield over the last 2 years. You can see where it bottomed out here, middle of last summer. You'll see a peak on the gold chart here, same time. And then as we came out, and especially once the vaccines got announced, we saw things get up to about 1.8%. But interestingly, that's kind of where it topped out, even though even though the inflation rate, the annual CPI kept climbing right up to here, it didn't get followed by the bond market. We've seen that drop in bond yields kind of flatten out towards the beginning of August. I'm sure if you trade the gold market or gold stocks, you'll remember the beginning of August. That was interesting, to use the old Chinese curse. And that is kind of where it reversed again. But we're not seeing much of a move. Yeah, it's sort of grinding its way higher. But really, I mean, the 10-year yield is only at 1.3. These are done in 10 basis point increments. So this 13.44 is actually 1.34 in terms of the actual rate. So, I mean, it's very hard to imagine the way bond traders are trading this right now, unless everybody has a change of heart. I just don't see how we get to a situation where we're going to have positive real rates. They'd have to move up literally 3 or 4% from here, and I just don't see that happening. And they're not even back. They're not even back to where they were, or they're not even close, really, to where they were pre-COVID. So the bond market is definitely sending the message that they're not expecting higher inflation. And keep in mind, during this latter period, there's been a lot of treasury issuance, and there's going to be a lot of treasury issuance at the rate the governments are spending money right now in the U.S. There's going to be a lot more treasury notes issued, and it's actually kind of impressive that the interest rate has really only moved up about 0.25% in the last 3 months in the face of a lot of new issuance. That tells you how strong the demand is. Demand for treasuries is very strong. So there's obviously a lot of uncertainty out there. So, I mean, what the hell is wrong with the gold market? I'm not entirely sure anything is wrong with it, really. I should preface it by saying that. I know it feels like crap to most of us, and we're definitely not happy about where some of our stocks are trading. But really, I mean, this is a pretty big move. I mean, it went from 1,400 to over 2,000 in the space of under a year, in about 9 months. That's a pretty big move for the gold market. Some of this was topping out. This spot where this topped out. This is where yields bottomed out last year. So the initial reversal here was people saying, okay, well, that's the end of lower and lower negative real rates. So the pullback you saw here was a lot of this was consolidation. And again, when we saw real rates start dropping off again, in large part, really, because inflation was going up, we saw another ramp up above the 1900s, and it's just flattened. Sorry about that. It's just flattened out since then. This was another bottom, actually. The most recent bottom in bond yields was when everything got slaughtered at the beginning of August. Bond yields are up a few basis points today, and that's helping gold and silver and everything else get slaughtered today. And that's really one of the most frustrating things lately, has been metals in general, but especially gold and silver, react negatively to what are, in the scheme of things, very small moves. I mean, we're talking 5-10 basis point moves. I mean, that's nothing historically, but you'd think the world was coming to an end every time the bond yields go up a few basis points. That everybody in the metals market just completely flips out. I find that quite odd, and it's, people are obviously seeing something or think they're seeing something going forward, and I'm really not clear on what it is. One thing that I guess, it's been part of the push, but it's pretty hard to make an argument and blame it on the U.S. dollar. I know that's the traditional nemesis of gold bugs everywhere, but this is a 1-year chart of U.S. dollar, and it's essentially hasn't gone anywhere in the last year. Yeah, it's gone down, it's gone up, it's gone down, it's gone up, but it's pretty much where it was a year ago. So I wouldn't get too caught up, and I try not to get caught up in the short-term moves in the U.S. dollar. Although I'm well aware of the fact there are traders that trade the gold dollar pair. You can see that today. The dollar's having a good day today. That's definitely increased the selling in gold, but I think that's a very short-term thing. Medium term, I'm just not as sold on that being the factor. Like, it doesn't, if you overlay this on a 1-year gold chart, the correlation is not that great. And so I think, I do think that one thing that we don't have here, we don't have that sort of longer term sort of slide down, ramp down in the US dollar. We did see that, for instance, we go back to the 2000s. Part of what, China was obviously then and now really for non-precious metals, it's the big buyer. But part of what helped commodities in general was you did have this long, and it was a pretty significant slide by the end of it in the US dollars through the, like 2003 to 2008. It dropped about 20%. We don't have that this time. We don't have a rise that explains some of the pullbacks. We're not getting that ramp down either. We did get one through late 2020, and it was definitely it was a factor in it going up. But I just, I look at this chart and I just can't see it as being the main factor. There's something else going on here. One thing that it has helped in the negative real rates and strong economy coming out of COVID, if you look at these base metal charts, the base metals are actually acting a lot more, normal, I would say. This is the kind of action you would expect with a strong growth profile coming out of something like COVID-19 last year. It's pretty hard to be unhappy about any of these base metal charts. They all look great. Because keep in mind, when you look at something like, say, zinc, that's like a multi-decade high. We're not that far off of it. Most of the other ones, nickel's not a multi-decade high, but it hasn't been trading in this range for 10 years now. The same copper is close to its all-time high. Of course, you can see the all-time high in the chart there. These all look pretty good, and the supply chain issues that are a bugaboo for other parts of the economy, they're obviously a positive if you're someone who's trading base metals. I don't think those supply chain issues go away quickly. I do think the demand change with the move to electrification, that's quite real. And politics, which is something we probably all shake our fists at. I'm sure you all own one or two stocks that are being held up by permitting or politics. God knows I own a few. That's a real downside for those individual names, but that's actually an upside when it comes to longer term pricing story, because there's just going to be trouble. There's going to be trouble getting some supply to keep up with demand. You don't need huge demand increases for copper and zinc and nickel and lead and iron ore to go through the roof if nobody's letting anybody build a mine. You don't really want to be trapped in one of those companies that can't build a mine. But if you're thinking in terms of attention for the sector and explorers, ironically, it's not a negative thing. It's not a negative thing for them. It's a negative if you own one, and I own a few, but it helps in terms of it's just going to make the supply side that much tougher to keep up and the prices that much better going forward. I wish I had some nice, neat explanation for gold's moves, but I don't really. I think some of this is fear of taper, which is coming at some point. I'm not one of these guys that believes the Fed's never going to taper. I think they are. I think they'll probably start late this year. I think the market's vastly overreacting to the impact the taper is likely to have. Well, what the taper really means is we're going to go from buying 120 or 150 billion in treasuries a month or a week, and we'll take it down by 15,000 or 15 billion a month over the course of several months to get it down to zero, which doesn't mean we're selling bonds. It means we're not buying bonds. They're not even talking about selling them or quantitative tightening yet. We're nowhere near there. I think inflation is mainly transitory, but transitory in this case is probably at least a few quarters because of supply chain issues. And like I said, I don't see some things like rents and wages. I don't see those falling back until there's a recession. So as long as this expansion goes on, we're probably going to keep seeing, say, somewhere I would say between 2.5% and 4% inflation, probably on the 4% side. That, in my mind, is more than enough to keep real interest rates negative. It doesn't matter which party's in power in the U.S. Republicans actually run bigger deficits historically than Democrats do. Both of them are quite happy to do it right now. I don't see that changing. So we're going to see, the Fed's really painted into a corner. Their job is going to be to keep the bond market from freaking out as they keep rolling out these treasury issues, which they're going to do unless we go to MMT. And if we go to MMT, then all bets are off and you better buy gold stocks and metal stocks handed over fist, because the US dollar is going down the tubes if they do that, which is fine with me. And like I said, everybody's forgotten already, gold did have a big move next year, I think it's very easy to make the argument, really, that what we're going through right now is simply a consolidation, a larger bull move. There were 2 or 3 of these during the 2000s. If you think back to it, there were 2 or 3 very dead periods, and they weren't like a month; they were like a year and a half. U.S. dollar decline stalled out. That might be it for dollar weakness. Really, the big competitor is the euro. The euro is actually coming out of their deflationary period, same way as the U.S. is. In the case of the Eurozone, it's actually great news that they have a couple % inflation now. I mean, they look like they were in a deflationary spiral. So I don't see them really wanting to screw that up, but it could be that they don't stay as far behind the Fed when the Fed finally does start moving rates up. And again, when they do that, I'm expecting very small rate increases. And this expansion coming out of COVID, I don't see anything in the short term that's going to stop it. This is probably the weirdest economic cycle in history. So honestly, I have no clue what's going to stop it. It's probably going to be something none of us have thought of, but I don't see any particular reason to think it's going to end soon or even soonish. And that being the case, base metals are going to keep being strong. And I think gold will ultimately get stronger again. We are in the right environment for it. I think we're mainly in a consolidation. Hopefully it ends soon.